Good morning and welcome to this Monday, October 24th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we wrapped up last week rather strongly. We had a pretty decent week. S&P 500 up almost 5% last week. NASDAQ up almost 6%. We talked about it going into the week, though. It was option expiration week. Had a lot of in-the-money puts. We've talked about this many times before. There were some gap ups. There was some back and forth during the week, but overall, market went higher. And in the process, probably saved market makers quite a bit of money in terms of having to pay out options. It's one of the reasons why, these calendar month seasonality patterns work so well. We've got new money coming in at the beginning of the calendar month, some additional money coming in middle of the calendar month, and we've got options expiring the third Friday of every month. And if you don't understand how all that ties into performance, then you're sitting squarely behind the 8-ball. Anyhow, it was a really nice week. But we've got another week now ahead, and this week historically is the worst week of the year. The October 21st close through the October 27th close historically has been the worst week for the stock market. Well, for the S&P 500 since 1950 and for the NASDAQ since 1971. So I've had some questions come in. Well, what do you think is going to happen this week? You've got the positive divergences. The market's had a nice week last week, but you've got bearish historical tendencies. What do you do with that? It's a great question. I can't predict what the market's going to do this week. I can only tell you I'm still bullish long term, that this week historically is not good. I'm planning to just kind of stick with the QQQ, which I have, because I do believe a long-term bottom is in, or we're certainly near it, if we haven't already set it. And I know what the first leg of the uptrend looks like. It's usually pretty swift, and I don't want to miss it. So I'm willing to risk with, say, the QQQ, I'm willing to risk to the downside this week. That's how I'm playing it. Does it mean we go up? No. If we weren't in a historical bearish period, I'd probably be a little bit into some of the leveraged ETFs. I will not do leverage ETF on the long side when I know historically I'm in the worst week of the year. It's just all about evaluating risk and how much risk you're willing to take. I'm not willing to take that much risk. I'm okay being on the long side, given my long-term signals, the fact that we are, by the way, when this period ends on Thursday at the close, we then go into the best historical period of the year. The close on October 27th through the close on November 5th. The best period of the year. So it's almost like, turning the cold water off and turning the hot water on at the close on Thursday. That's been the history of the market. Can't tell you why. I don't really understand exactly why, but it's history, and I study history. It's not my number one indicator, but it's certainly a secondary indicator that I use. So anyway, that's the way I approach it. Let's go ahead and jump into all of this. Let me take everyone over to earningsbeats.com. If you are new to Earnings Beats, if you go over to our website, earningsbeats.com, both plural, scroll down, free newsletter, Earnings Beats Digest, out 3 times a week, Mondays, Wednesdays, and Fridays. Today, talked about a stock that I really like from a long-term perspective. It's a growth company. Could it get hit in the short term? Yeah. If the market goes down and interest rates keep going up, then yeah, growth stocks can get hit. I can't promise you it's not going to get hit. But after the selling that's taken place on this stock and many growth stocks, believing that the bottom is either in or rapidly approaching, I'm pretty bullish some of these companies. But short term, I can't guarantee the rates don't go up. If rates go up, these growth stocks probably going to get hit. Anyway, I featured one of those today in the EB Digest. Every day or every other day, basically, I'm featuring something that talks a little bit about how we approach the market. Usually it's something to do with earnings. My background, I was a practicing CPA for 20 years. I think fundamentals are really important in the market, but I don't buy based on fundamentals. I buy based on technicals. I evaluate many times on both. Also throw historical tendencies in there. I think it's important to kind of mix that in as well. Anyway, those who subscribe not only get a free weekly or free 3 times a week newsletter, which normally, by the way, is 2 paragraphs and a chart, very quick read. So you don't have to worry about thinking, wow, 3 days a week, I don't have time for this. It's very quick. Could give you a trading opportunity if you're a trader. Of course, that's completely up to you. But the other reason to be part of this community is we have a lot of free events. We had a free event last week. It was our sneak preview of our Q3 earnings season, where we just talked about a couple of earnings reports that had come out, talked about a little bit of companies that would be reporting this past week. Well, tonight's the big event. This is the one where we're looking out over earnings season. And basically, I'm going to go through and tell you some of the companies I think are the best looking charts, best looking companies going into earnings season. Some of the charts I would absolutely stay away from, would want no part of them. I'm going to go through all of that after the bell today, 4:30 Eastern. That is a members only event. Last week was a free event, our sneak preview. Today, we're really going to get into the meat of earnings season, what we see looking ahead. I think it'll be very educational. Hopefully set you up with some nice trades as you head in and throughout earnings season. But that will be at 4:30 later. You do need to be an Earnings Beats member. Good news, though, we do have a free trial, 30-day trial. So if you do want to come tonight, see the event, start your 30-day free trial. You will have to give a credit card for this, but we will not charge your credit card before your trial expires without sending you a note first and telling you that your trial is expiring. And if you don't act or you don't tell us to cancel, you don't do something, you're going to get charged. But we're not just going to let it go and hope you don't see it, kind of a thing. Listen, we don't want you to be a member if you don't like our service. Or if you might like our service, but you may just not find it helpful for what you do. That's fine. But if you like the service, which I think you will, most of you probably, give us a shot. All right. So anyway, here's the event, Q3 earnings. So you can read that. That's on our homepage. I'm going to talk quite a bit about the upcoming earnings, and we'll go through a lot of charts tonight. So if that's your thing, I think you'll enjoy it. All right. Let's move on to the daily market recap. So what happened on Friday? What happened to close out the week? Well, I'll tell you what happened. The Dow Jones went up 750 points. S&P 500 up 87. NASDAQ up 245. Mid caps up 47. Small caps up 26. Big moves across the board. Small caps now above the 20-day. Mid caps now above the 20-day. NASDAQ now above the 20-day. S&P 500 above the 20-day. Dow just a little bit below the 50-day. Right here, you can see we closed at 31,082. Got to get to 31,125. So almost got to the 50. Basically, we are on the 50-day. And clearly well above the 20-day, which is down at 30,162. So here's good news. You can't start an uptrend until you get above your 20-day moving average. We're above on all 5 indices. Now, last time futures had been kind of all over the place, and I didn't even talk about the futures. Let me see what. I'll tell you what. I can. We'll come back to this. Let's take a look real quick. I'll just get the up-to-date futures on the spider. Up almost 0.6% this morning. QQQ was not doing well. I know it was underperforming the spider earlier. It's up 1/3 of 1%. Diamonds up almost 0.7 of 1%. So it looks like we're going to get off to a decent start, which is unusual, by the way. The Monday after options expire, that's the worst day of the calendar month. Monday after options expire. Now, thing you have to realize a lot of times is that heading into option expiration week, the market typically is going up because we're usually rising. Stock market usually goes up and then pulls back option expiration week. You got to remember, this month we were going down and we had a lot of in the money put premium. And as a result, the market is going up. So this move, this, futures being up today might just be a little bit of a continuation from what we saw last week. But normally what we see is the market going up into option expiration week because you got new money middle of the month comes into the market. Portfolio managers, hedge fund managers, and so forth, market makers are anticipating that money coming in. So they're usually buying ahead of the 15th. Then you typically see the 15th through the 18th pretty strong with new money coming into the market. And then as you expire or get close to monthly option expiration, that's when we tend to see the market come back down. Just remember that everything was kind of reversed this month. Anyway, overall, I thought, things look pretty good here heading into this week, except the week itself being not so great. But anyhow, we'll have to deal with that throughout the week and see if the market can hang in there. I would suspect, given that things are different this month, if any of this normal weakness from the 21st to the 27th is options related, I don't think we really have that issue this month. So maybe it won't be as bad. Maybe it'll even be higher. I don't know. But I do like several things in the market, though. I love the positive divergences that we're seeing almost everywhere. I still love the AD lines. These AD lines are staying up pretty close to the top near 2022 highs. I can tell you that the last two secular bear markets, the AD lines remained up for a while, but when they finally took that next plunge, the AD lines fell apart. So if you're looking for something that, hey, how do we spot if this thing's really starting to get worse? Well, when you go down and you start seeing a lot of red-filled candles, you see bad rotation, bearish rotation, back toward defensive groups, and you see that AD line going down, those would be pretty good signals that you want to be careful. I'm just not seeing it. I call what I see. I mean, there were a lot of folks probably going into the end of last year that thought I was a perma bull because I was always talking bullish during the pandemic. I said, this is short term. We're going higher. During the 2018 trade war, went down 20%. I remember talking about it at the end of December, saying the Fed was not going to raise rates like they talked about. They ended up lowering rates, market soared. So I get it. I understand why folks are saying, hey, you're always bullish. But 2022, I was not bullish. End of 2021, I was bearish. I was making calls for the S&P to go as low as 3,500 back when it was over 1,000 points higher. I changed my tune in June because of the signals. I wanted to see sentiment reset. Sentiment reset. I wanted to see money rotate back toward aggressive areas. Money rotated. I wanted to see positive divergences develop. We had negative divergences at the end of 2021. Positive divergences developed. I mean, all I did was turn bullish when things hit that I said I wanted to see. So I'm bullish. I'm not looking at the market like I was back in January, February, March any longer. I'm not looking to short. If it goes down, it goes down. I'm not going to profit from it. I'm not going to short in this environment. My signals are not telling me to short. My signals are telling me, it's a lot like I wrote an article over the weekend. If you had a chance to see it, if you're a golfer, maybe you'll kind of get the analogy. But, the big question is, do we have a big drop ahead? That's what everyone's wondering. Are we done? Is this it? Most people think we've got the bomb that's still going to drop. I would say the overwhelming majority of folks believe that we are going lower, maybe a lot lower. And my response to that is great, because this is exactly what we've been needing. We needed sentiment to turn from, the stock market's an ATM machine, it's just going to keep going up no matter what, to, oh my gosh, I don't ever want to touch the stock market again. That's what we needed. And that's where we are. So the question is, do we have a big drop ahead? My answer, I don't know. But my signals are telling me that the risk of shorting after you're already down 25% and all these signals are showing up, I think the risk of shorting is like, as I went through this article and said, it's like stepping up on a par 4 dog leg right over water, got water all the way down the right side of the fairway. You got a nice open fairway way left. If you decide to go that way, though, you got a longer shot into the green. If you want to go over the water, you can, but guess what? If you land in the water, you got to go all the way back to where you started from, and you got to hit another shot. How much risk are you willing to take? Is it going to be tin cup? You're going to keep dropping a ball and plunking them in the water? That was the equivalent of the beginning of the year trying to be long. You just kept plunking them in the water. There was no dry land anywhere. Now, I think with the signals, the safe play out toward the left side is being long. I think the risky play is being short after it's already dropped 25%. The last 14 bear markets, 11 of them basically ended at this point. There are 3 since 1950 where you could take it over the water and be safe. You had 1973, 74, 2002, 2003, right in that, or 2001, 2002, and then of course 2008. Those were the only times where we got down 25, 30%, and it was still okay to try and hit it over the water. So when I look at the market, I chuckle sometimes at some of the comments I get. Oh, you're wrong. You called the June bottom. It's not about whether the market goes lower or goes higher. It's about the risk you're willing to take. Hey, if you think we're going down to 2,000 on the S&P 500, 200 on the, 2,000 on the S&P 500, then by all means, short. Go for it. You'll make a lot of money. But if we end up going back to all-time highs like we do in cyclical bear markets and you're shorting, well, that's not going to work out well. So you got to evaluate that risk. And that's where I believe it's riskier. Listen, here are the 2 chances. There are obviously other possibilities in between. But if we look at history, at the 14 bear markets, 11 out of 14 of them that have gotten to this point tell us we're going back that way. 3 of the 14 have said we're going to do this. I don't know which one we're in, but like I said, sentiment's been reset, positive divergences, rotation is still bullish. I'm sticking with what I called in June. I think the market's bottoming. It's bottomed. It's bottoming. Call it what you want. I don't care. Am I going to change my tune if we go to 3,400 or 3,300? Let me see what my signals are telling me. I don't know. Maybe I will. If all of a sudden the growth stocks completely fall apart again, market probably is beginning to fear those higher interest rates and that inflation's probably not under control or is going to get out of control. Those would be signals that would tell me to get out of the growth stocks and be on the sidelines. At that point, then it would be riskier to go over water. That would be the bullish scenario. So anyway, that's where I stand right now. There's still a lot of folks that seem to not understand where I am and where I stand. So just wanted to spend a little bit of time clearing that up. Looking at the individual sectors, by the way, on Friday, materials led, all 11 sectors were higher. Materials up 3.5%, financials up 3%, discretionary almost 3%, energy close to 3% as well, industrials 2.75%, all definitely improving, but still a lot of work to do. You can see discretionary down here finished at 142.40. We still got another $1 to get through the 20-day EMA. Again, you can't be in an uptrend if you can't even get above your 20-day. So that's the first step. We also have positive divergences. That normally leads to 50-day tests. Normally. Again, we're evaluating risks. Am I guaranteeing we're going to the 50-day moving average? No. Well, I can almost guarantee it on the Dow because we're just about there. On the others, am I guaranteeing, on all these sectors, are we going to go back up to the 50-day? I don't know. But where you have positive divergences, I mean, when I see financials with a new low there in October, higher PPO, I think 50-day test. I stopped thinking failure at the 20-day. I think we're going to go through. We're going to get a 50-day. We're going to reset that PPO back near the center line. From there, I don't know what's going to happen. I watch to see, do we hold the 20-day on the way down? If so, we got pretty good odds of trending back to the upside. If we don't, we go back down below it, then we've got to be careful and we have to consider the fact that, hey, this may have just been a short-term reset of the PPO and we're going lower again. I mean, we can try to predict those things ahead of time, but I use that 20-day. I mean, if we go through across all of our major indices, we go through and go up to that 50-day moving average. When we come back down, we will be at that point in the most bullish time of the year historically. If we come back down, hit that 20-day, I will be in leveraged ETFs. If it fails, I'll get right back out of them. But if it holds, it could be the start of a big move to the upside. And that's when you want to be in the leveraged ETFs. Not when you're going sideways, not when you're breaking down, when you are trending higher. That's when I want to be in leveraged ETFs. I don't have any signs of that yet. I'm not going to get into a leveraged ETF right now and hope in the worst week of the year that we go higher. I'm just not going to do it. I'll be in the QQQ, not doing the QLD, certainly not doing the TQQQ, which is the triple. I'll leave that up to everyone else who wants to do that. But I have a certain way of trading and I need to make sure my stops are in place. I need to feel like we are trending up and I need to get that entry point pretty close to a stop. I don't want to leverage and then hold and watch it go down 10%, 20%. So anyway, let's look at the 10-year Treasury yield. Get you an update here. We are up slightly. Let's see. I also I was looking at the futures earlier, but anyway, right now we've got the 10-year Treasury yield up 2 basis points, 4.23%. Looked like maybe we topped on Friday, but we've seen this before. Let's see how, if we get a little follow through the downside, then maybe we've got a top in, or at least a short-term top, which would be good for the market. But if we don't, and we go back to a new high, I will say that the market has held up reasonably well, actually maybe better than that, considering how much further the 10-year Treasury yield's gone up. I mean, mid-June, the S&P 500 was at 36.66. That was their closing low, 36.66. At the time when we got up to 3.48%. Now we're up to 4.23%. And when you look at the S&P 500, we're at 37.52. We're up almost 100 points from where we were back at the June low. And even the NASDAQ, if we look at the NASDAQ, we're above where we were at the June low. The NASDAQ with the 10-year Treasury yield up 75 basis points from where we were, you would think the growth-oriented NASDAQ would be down significantly from where we were in June. To me, it's another signal. The market is, even with things worsening, the actual news is worsening, and yet prices are not dropping. Or at least they're not right now anyway, below where we were in June, which I think is pretty encouraging. We've had a couple of inflation reports that have been bad. We got the Fed hawkish. We got rates going up, and yet here we are sitting above where we were at June. I see that as bullish. The other thing that I find bullish is look at the VIX. VIX has not been able to take out these earlier highs. Every single time we've gone down and put in a new low on the S&P 500, the VIX has been lower, not higher. Here, February, March, then early May, then into June, then these lows. I mean, every single one of them are coming down. Fear is coming out of the market. Fear is what drives the market lower. If fear is coming out and we're resetting and everybody's buying puts, this is what I was talking about with resetting sentiment. I just think I'm not saying we can't go lower. It's definitely a possibility. I just think the risks of being on the short side and hoping that we go lower, I believe the risk is greater than getting in on the long side after you're down 25%, especially with the positive divergences, the sentiment, all the things I've talked about, the rotation. All right. Let's talk a little bit about earnings. So earnings are going to really start to pick up this week. We've got Microsoft, Apple, Google all coming out later this week. First big report that I'm going to be watching later today is going to be Cadence Design, CDNS. This is one of our portfolio stocks. I wouldn't be surprised after the sell-off, and we'll see what happens. I think we're going to get a good reaction here. And the reason I say that is mostly because the stock relative to the software group remains strong. Software has been going down, down, down for a while. And if you look at Cadence Design, you're looking like, well, it's been going sideways. But in software, sideways is really good because software has been hammered all year. So CDNS relative to software, it was just at a 52-week high 3 weeks ago. So yeah, we've seen a little bit of weakness right here, but we're in a quiet period. This weakness should not be coming from Wall Street firms, from meeting with the company management team. That all happened back here. And all of this back here led to CDNS being at a 52-week relative high to its peers. So yeah, we've been going down. The market's been a little rough. Came back up with options expiration. But why was the stock a leader at the end of the quarter? I think we're going to find out later today in the call. I think we're going to have a big report on Cadence Design. I could be wrong. If you decide you want to hold into an earnings report, that's your risk, not mine. I'm just giving you my opinion. I think that there could be some good news coming out with CDNS. We'll see. Another one that reports later today, Discover Financial Services. Here, I'm looking at it on a relative basis. It just goes along with its group, and its group's been going lower, so it's been going lower. I don't really have an opinion here. I mean, the group's been trending lower really for the last several months. Stock just kind of going along with the group. I don't know. I'm not seeing anything. You do have a double bottom in, technically. You'll want to watch when it does open. Let's see, the close there was 89.02. This open was 89.50. 89.02 is a level that I'll watch on DFS. If it opens beneath that with its earnings, I would be very careful. If it comes out with decent news and it gaps down above 89.02, might be an interesting trade off of that support. Maybe you wait and see intraday if it goes down below these lows. And then when it comes back up, gets back through the open, that's where I would be considering a position. Because then you got your intraday lows you can use as your stop. So at least you can evaluate your risk. Let's see. We're just about ready to wrap up here. Tomorrow, Microsoft will be reporting. Let me give you that one. Remember, later today, we got a big event, Q3 earnings. We're going to be going through a lot of this, what I'm doing right now. Microsoft, AD line, not bad. Price has been going down, but look, I mean, it went up. It's been holding its own near a 52-week high relative to its peers. This is, 2022. So Microsoft, even though it's been going down, it's well off its high. It's been down a third off of its high. On a relative basis versus software, it's actually held up pretty well. So I find that to be encouraging, even though, again, software has been weak. I think a lot of participants just looking for a little bit of safety in software. And not that Microsoft necessarily is a safe stock because it is a growth stock. It's safer than a lot of the other software companies. All right, last one I'll give you here is Texas Instruments. This is one I'm really interested to see when it comes out. This also is in one of our portfolios. Look at the relative strength relative to semiconductors. I mean, it has been on a tear versus its peers. Now, that's mostly because its peers have been awful, and Texas Instruments is still remaining above its recent low. So semis kept going lower. Texas Instruments did not. Maybe we find out when the earnings come out, and that should be, I think that's tomorrow after the close as well, but double check me on that. All right, let's just take a look now at what the market's doing, then we'll wrap up here. Dow Jones up 184, S&P up 14, NASDAQ not doing anything, down 3 today, so that's kind of unusual at this point, but overall, still good to see a lot of green. The VIX is up, though. That's unusual with the S&P up. So we'll continue to watch that, but it is way below the 34, 35 area, and that's, we start getting up above 35, and then I would be a little more careful with the market. Right now we're at 30. That's not good, by the way. That's still high. That still could lead to some rather significant selling at some point. But I think if you're talking about things really getting bad, I think I'd like to see the VIX up above 35 before doing that. All right. That is all I have for today. So I do want to thank everybody for tuning in. Again, go over to earningsbeats.com. We have this free event coming, or actually it's a paid event. Got to be a member. But that's at 4:30 today. You can get a free trial though, 30-day trial. So just go into our website, hit that no cost trial, and would love to have you join us later this evening. Have a great day, everybody. I'll be back tomorrow over at Stock Charts for your next Trading Places Live. All you got to do is go over to Stock Charts right there at Stock Charts TV, 9 o'clock tomorrow morning. Click on that and you'll come right into the show. Have a great day, everybody. Happy trading.